Market Mastery with me, Christian Rauchenwald, eToro popular investor. In this series, as you know, I'm going to share the other screen real quick, or I'm applying Elliott Wave Theory or Elliott Wave Principle on different charts right now on the SPX 500 to basically determine the long-time trend outlook and try to forecast where markets are going. Now, if you're new to Elliott Wave Theory, you haven't heard about it and whatnot, there are two things that you should do. First, it's going to be blurred, but still, use the link in the description down below and you can find a link that allows you to read this book for free online, or if you like it, like I do, you can then order a physical copy. And second, there's another link down there that tells you about the one-page cheat sheet, something that summarizes all the different wave patterns that are part of Elliott Wave Theory into one neat A4 page, and that we're using throughout those series constantly. So you should definitely download that free PDF and print it. Yeah. Now, that said, it's Thursday, and while this stream is pretty much more or less daily, there will be no stream tomorrow simply because Friday is usually the day where I take the time to do grocery shopping and other stuff. So it just doesn't fit into the schedule. And besides that, it's been an incredible first week with now episode 3 of the stream, if I got it right. Started a lot of new streams this week. So yeah, episode 3 of Daily Market Mastery. I'll still have to see how I'll balance things, because right now I have around 3 live streams daily, ranging from my main YouTube channel that deals with passive income and cryptocurrency, then this YouTube channel that deals with being a popular investor and investing, and last but not least, my Twitch channel that deals with me relaxing in the evening in front of my computer or Xbox. Yeah. So still have to find the right balance of how many streams and what duration we can handle. Overall, while the first episode of Daily Market Mastery is roughly an hour long, because we cover a lot of basics of Elliott Wave Theory, in future episodes, so like yesterday and today, I'm going to try to keep it to roughly 30 minutes. To that purpose, I'll use the stopwatch app on my phone to remind myself, okay, enough is enough, which might mean we definitely will make some progress with the labeling that we're doing, and hopefully you are able to learn something, but it's possible that we have to cut it short somewhere in the middle. Anyway, if you have any questions along the way, don't forget to just ask them in the chat. I'll do my best to answer them as I go. And additionally, since my stream setup is not fully completed yet, which is something I'll also have to find the time for, hopefully on the weekend, remind me if I mistakenly start talking about something while still something else is visible on the screen or so. So yeah, in other words, try to, in quotes, contribute either with your ideas, suggestions, questions, and or feedback. Yeah. With that out of the way, we basically jump to this screen here, which is, as you might know if you watched previous episodes, Motive Wave, the software that I'm using because it integrates so amazingly well, or Elliott Wave Theory is so amazingly well integrated. Besides that, if you're curious what else we're going to use, we sometimes rely on TradingView. There's also a link down in the description below, which is also free, but also offers a paid plan for certain features. So, but yeah, we use it mostly to double check if our data feeds are showing us all the history that there is or not. And additionally, we're using Wave Basis, which there is no link in the description below, simply because it also has Elliott Wave Theory built in with some neat automatic price range projections that we can see exampled here, which is, by the way, if you're curious how that whole mess became to be on the screen, check out yesterday's episode of Daily Market Mastery. Now, last but not least, the obvious thing, don't forget to hit like, subscribe, and enable your damn notifications so you actually get notified when I go live, in case it's not scheduled or you forget about it or any other reason. You obviously help me a lot by subscribing and by liking the video, and it doesn't cost you a thing. So yeah, that's pretty much it. Now, what else do I want to share? So my eToro portfolio that you can also find a link down in the description below. But yeah, almost forgot a couple weeks ago, overview tab, sorry. A couple weeks ago, I actually got this nice little certificate notification from eToro itself. So congratulating me for 3 years in profit. And I'm hellbent to turn that into 4 years in profit, although it's going to be, I would be surprised if we reach last year's profit of 45%. So I'm not hoping, or I'm not expecting that. Even the 2020 profit of 30% in only, what was it, 8 months, might not happen this year, but I'm hell-bent on turning the current minus 11% around, which might seem shocking to some, but if you look at my history, it's actually, not the norm, but it just happens as part of my trading. If you aim for higher profits, you also have higher drawdowns in losing months, like here minus 11 or here minus 14. But on the other hand, you then also have higher winning months, like here almost plus 20, plus 15, plus 13. That here is the exception with plus 66, which was GameStop pretty much. But yeah, anyway, with that out of the way, let's jump back into Motive Wave, where we, as said, are currently looking on the SPX 500. If we zoom out here, zooming out, okay, it needs to load there, monthly chart, yeah. So we can see that we are looking at it from 2009, where again, in trading view, we would have a history from basically almost the dinosaur age, from like 150 years or so from now, or back from now, yeah. Which means, and that's the only important reminder that I'm going to repeat in this episode as well, is since Elliott Wave patterns are always like this, for example, 1, 2, 3, 4, 5. But we are only looking at this part here right now, and then that 1, 2, 3, 4, 5 becomes an impulse wave of a higher degree. So the entire 1, 2, 3, 4, 5 is basically wave 1 of an impulse of a higher degree. We have to remind ourselves that we are only looking at what's happening here, or what happens after this part, without having all that previous information, which is important when we try to determine just how far of a corrective wave 2 this here is supposed to be. Because if we only look at this, we would expect a smaller correction, whereas if we look at the entire history, the story suddenly changes and we look at the bigger correction, yeah? Although it might seem scary if we have something like this happening, yeah, it's simply the way Elliott Wave Theory works. People might argue that that might not happen, it's delusional, whatever, yeah, time will tell. I'm a strong proponent of Elliott Wave Theory, and yeah, while it's always sad to have like economic crises, it's still, if you play your cards right, a way for you to profit. And yeah, so with that, I'm going to hit start on the timer. So 30 minutes from now are starting, plus minus a few. And we're going to zoom in back here. So as said, we labeled from 2009 that the entire thing here is 1, 2, 3, 4, 5, and that's then making up wave 1 here, and we're currently trying to confirm wave 2 or work out wave 2. And in that wave 2, we already determined, okay, that based on, and I'm gonna move the book aside and quickly share the desk cam. I adjusted the zoom, it's gonna be better than it was yesterday, it's still not perfect. But based on a one-page cheat sheet, if you guys take a look at an impulse wave, you see that wave 2 is always any corrective pattern, but not a triangle. And if you look at the table, it's with 42% probability a zigzag, and with 40% a flat, with both being those two corrective patterns labeled A, B, C, which means we have an 82% chance that it's going to be this or this, and which is going to be labeled ABC, with the only difference on of like how those waves subdivide. So where a zigzag would have the first wave being an impulse or a leading diagonal, in a sideways or a flat corrective pattern, the first wave would be another corrective pattern, any of the other corrective patterns to be more precise. And we already, if we circle back to screen share here, we already worked out that basically here down we can fit in nicely an leading diagonal, as we nicely see highlighted for a second here, yeah, which would point towards I need to set up my Stream Deck to automate those things, to it actually being a zigzag. So currently we keep that assumption that it is a zigzag, and we're currently trying to confirm wave B here, and wave B can be any corrective pattern. And if we look at the table, then wave B will be with 30% probability another zigzag, or with 40% another, or a flat, which means again, there is a 70% chance that our wave B, so the second wave of that corrective pattern, should subdivide into ABC, which gives us a lot of probabilities to look for, because it can either be, again, another impulse or leading diagonal for the start of this subwave here, or it could be any corrective pattern, which makes it a little challenging, but we're gonna figure it out. So circling back to screen share, and there we go. Yeah, so obviously we're going to have a hard time. So right now we're assuming that the ABC here might subdivide like this, but with only 5 candles here, we will have a hard time to subdivide this. So we'll have to move in further or zoom in further by basically reducing reducing the time frame we're looking at. So instead of like the monthly charts, we are looking now on the weekly charts, which also might not be ideal. Gonna go to daily, and yeah, so that's gonna be better. Have to adjust the waypoints here because when we switch between time frames, that's the one not issue, but like yeah, thing that I'm not happy with motive wave with that when you switch down on the time frames, that it doesn't stick to or tries to pick the high point, and you manually have to adjust things. Yeah. Anyway, so looking at this again, if this were a if this entire wave B, so if we look at this, we're looking currently at this wave B. If this were to be a zigzag, then the first wave here would subdivide into an impulse or a leading diagonal. Now, an impulse doesn't work out because if we were to assume, I'm not going to use auto label, but I'm going to manually, I'm going to manually label that to show you where it's wrong. So if we say this is 1, 2, 3, 4, then we already get a warning because wave 4 retreats into the area of wave 1, so which cannot be the case here, yeah, because then it's not an impulse wave. It's one of the core rules, and it's also one of the reasons why I love Elliott Wave Theory or motive wave specifically for that, because you have the warnings, because there's, for example, a rule, wave 3 can never be the shortest, which in this case it would be, whereas, and the errors that tell you, okay, this is such a clear violation, what you just did is completely wrong, so it cannot be this. Now we can open the context menu and go to tools, Elliott Wave, and pick, what did we say, leading diagonal would be the other option if it would be a zigzag. And I mean, we can auto label it like this, so just drag it here, and that would actually work out. Doesn't look perfect, but theoretically it could be like this, although probably wave 4 might terminate here, but then we get the issue that wave 3 is the shortest wave. So if we assume it's a leading diagonal, then our safest way to confirm that would be, switching to the desk cam, would be to look up for a leading diagonal. We would have to follow this. So the first wave has to subdivide into an impulse or another leading diagonal. Wave 2 would be any corrective pattern. Wave 3 always has to be an impulse, and wave 4 is any corrective pattern. And then wave 5 has to be another impulse or an ending diagonal. Yeah? So in order to do that, we would have to look on a lower time frame. However, we can probably, yeah, like that. So like ballparking it, wave 3 would need to be an impulse, and if we have wave 2 ending here, that would actually work out. So I can even do that on that time frame already. So to make this, as you can see, an impulse wave that doesn't get any red flags. I'm gonna zoom in a little bit more, so maybe it's like better to see, and circle back. Yeah, so that we could fulfill. That wave 3 should be an impulse, but we have the problem that we then don't have a corrective pattern here. It's just down. There is no ABC or something. So again, that would require us to jump on a lower time frame. And again, wave 1 would need to be an impulse or a leading diagonal, which, yeah, we might be able also to just fit in here. Yeah, also would match the rules. And yeah, then we would have any corrective pattern, which, depending on where we put wave 4, yeah, like, so again, here we get the problem that wave 3 would then be the shortest wave, which is something we just cannot ignore. However, if we, yeah, like even if we move it here, so just to be clear, waves don't always end at the lowest or highest point. So there are also, like, if we think, for example, about contracting triangle patterns, then the wave would have a low point here, but then the triangle contracts and the end of the wave would actually be, for example, here. Yeah. Now, it's gonna be tricky if we look up. So sorry, I forgot to share the right screen. So circling back, yeah, again. So undo that. No, yeah, like let's let's label that part again. So yeah, sorry, that's the thing. Like if you notice that, please just point it out in the chat. So we said that wave A would need to be an impulse or a leading diagonal. Now an impulse didn't fit, so but a leading diagonal would fit. Yeah. Now and then part of that would be that wave 3 is actually an impulse wave, which we definitely can make work. 1, 2. Then we have the strong wave 3. Wave 4 either till here or till here if it's a longer corrective pattern, which might make sense considering the rule of alternation. So if wave 2 is a short correction, then wave 4 tends to be a combination or drawn out correction. So, but if we put that here, we definitely can fit that in here, probably more like this. Wave 1 also is supposedly an impulse, which even here we can fulfill without looking closer. And wave 5 is also supposed to be an impulse, which is gonna be tricky to confirm here, to be honest. I mean, yeah, we get here like we would need to zoom in, but even if we zoom in, so on a lower time frame, we would still run into the same problem that has to be wave 1 and that wave 2, and we would end up with wave 3 being the shortest wave. So that probably doesn't check out. Which, if we zoom out again, that we can also remove, which means that, and zooming out on the monthly chart and then zooming in that we see again, which means that this ABC here, which again, quickly switching there and then switching back. So, or 1 second, so screen share. So if we look at the entire thing, again, we have ABC and we're currently trying to just work out that middle part, yeah? And desk cam. So from the big ABC, we are only trying to work out that middle part here. And we said that can be any corrective pattern with a, what did we say, 70% chance that it's either a flat, a zigzag or a flat. And since for a zigzag, we would need to have another impulse or leading diagonal in the beginning, which we have a hard time fitting in here. And yeah, so have a hard time fitting in here, which makes it not more likely, but which brings our attention to try to confirm if it's a flat corrective pattern, yeah? And for that, circling back, screen share, and then basically here. So again, we try to figure out this part here right now. So zooming in again on the weekly, and yeah, if it were a flat corrective pattern, already on first glance, it looks better. Yeah, so sorry. Okay, then we would just say that here is a flat corrective pattern. Again, when we switch between the time frames, we have to adjust the candle positions partially, or not the candle, but the label positions. And we can see that that actually checks out really relatively nicely. It's not perfect, because then the question would be why we have a higher point here. And then here the high we have is 4,196, and here it's 4,151. Which is a little bit problematic. There is a corrective pattern that allows for wave B to go higher, but we more likely would look at something like this. In that case, we're also going to quickly, something that I rarely do on the stream, but we're going to quickly consult the book. So, and there we have in the beginning, in the beginning at some point here, all the wave patterns with their rules. There we have. So page 98, again, you can read the book online for free. There it's then not page 98, but you have to find chapter 2, guidelines of wave formations. And then there is the page that explains flat corrective patterns. Yeah, so the rules and the rules are, or the rules and the guidelines. And for those of you that didn't watch the first episode of the stream, so rules mean everything that is a rule has to apply, otherwise the labeling is invalid. Whereas guidelines means the more of them apply, the more likely it's the right labeling. So for example, if we wouldn't bother to try to confirm the waves of lower degree, then a zigzag would fit fine. And we could then say, well, it fits as a zigzag, it fits as a flat so far. And we could then look at the guidelines and see which of the guidelines fits the best, yeah, so, or matches most of the guidelines, and that would then be our current most likely forecast or projection, yeah. So as for the rules, a flat always subdivides into 3 waves, yeah, so A, B, C. Wave A is never a triangle. Wave C is always an impulse or a diagonal, which is good to know because technically we are looking right now only to confirm the flat that makes up. Yeah, it even for me gets confusing sometimes. Yeah, so we're assuming that we have a zigzag, and in that zigzag we are actually looking at that part here, and we tried to fit in an impulse that we couldn't confirm further. So wait, what? No, we are back at the side. Yeah, see, even I get confused sometimes, so no worry if it's confusing. We're actually looking to confirm the flat correction, and there wave A would always be any corrective pattern, yeah, and blah blah blah, but it's never a triangle. Although here the cheat sheet does not include that piece of information, although what do we have, ET and CT, it clearly lists 0% for contracting and expanding triangles, yeah, so that's good to know. Now guidelines, and guidelines are, okay, we have wave A, wave B. Okay, so we're not looking at a flat because the guidelines would indicate that wave B usually retraces between 100 and 138% of wave A, which is not the case here. So I'm circling back real quick, which means a flat corrective pattern would actually expect us to have wave B form a new high. Yeah, so we would need to have 100, so same length or longer for wave B, which kind of like throws a wrench into our wheels right now. Now wave C is usually between 100 and 160%. So a flat corrective pattern, and that is of wave A, which means a flat corrective pattern would, for example, look like this, where wave B basically builds a new high, or in this case, a new low, and then wave C recovers at least wave A again. So wave C could finish here, but could also extend, so be 168%. Again, those are the guidelines, not the rules, but if we are so far off from the guidelines, then we can already rule out that scenario. So with that, we actually, yeah, I'm gonna get my kitty bookmark that I stole or borrowed from my wife to bookmark that page right now, so we find it easier in a second. And we're gonna basically back to the drawing board. So looking at the monthly chart. So we agree that this is the high where we have an impulse wave ending, which means we are definitely in a second wave. We are definitely in a second wave here. We also yesterday already realized, where's there, that we are likely right now looking at the wrong degree, so that we are right now missing 1 or 2 wave degrees in between what we are labeling and what is actually the next smallest degree. Yeah, which if that doesn't make sense, check out the first episode of the stream because it covers those basics, or read the book. Yeah, and which means if this here is a second wave developing, so we're actually gonna approach this differently. Yeah, I mean, it means undoing a lot of things that we did the last 2 days, although they were also educational, but we're gonna do it anyway. So desk cam. So again, we are basically looking for wave 2 right now from the high in, when was it, December or so, 21, yeah, or November 21, yeah. And we know that wave 2 will be either a zigzag or a flat correction with 82% probability. So that's already an important piece of information. Now we also know that wave 2 will obviously be shorter than wave 1 because wave 2 cannot form a new low or a new high in that. So in this case, a new low, since we are going up and then down. So wave 2 cannot retrace further than wave 1. And we know that the wave 2 or wave 4 doesn't interact or enter wave 2 territory. So that we know irrelevant. We know that wave 3 is bigger than wave 2. Yeah, obviously. So we get a new high. It has to be bigger, otherwise it's not a third wave. So all of that doesn't really help us distinctively. So if we now go back into the book, but instead of looking at the corrective patterns, we're going to go a few pages earlier, and we are going to look at, same chapter. So chapter 2, guidelines of wave formation. In the book, it's page 86. And we're going to look at the motive impulse wave, which is one of the possible motive waves. So again, there is the impulse, and then there are the diagonals, which are the leading and ending diagonal. Yeah. So obviously, basic rule, an impulse always subdivides into 5 waves. Duh, we already know that. Yeah. So I'm going to also bring that paper up a little bit so we see the impulse here. And wave 1 always subdivides into an impulse or rarely a diagonal. Yeah, like we see that here, 93% of cases, wave 1 will be an impulse. 7% of cases will be a leading diagonal. Yeah. Wave 3 is always an impulse. Yep, we know that. Wave 5 always subdivides into an impulse or a diagonal. We can see the same thing here. So wave 5 is 93% impulse, 7% ending diagonal. Yeah. Wave 2 always subdivides into a zigzag, flat, or combination, which we also have here. So it's 42% zigzag, 8% double zigzag, 1% triple zigzag, 40% flat, and 10% double free. So we know that. Wave 2 never moves beyond the start of wave 1. We know that. Wave 3 always moves. We know that. And never are waves 1, 2, 3 all extended. So there are also extended waves, which we're not going to dive into right now. And then guidelines. Wave 2 is usually a zigzag or zigzag combination. What else do we have about wave 2? Wave 5, blah, 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 blah. Blah, blah, blah. Okay. Nothing that helps us right now. So we're going to circle back and going to do that. Actually, we're not going to circle back. There was another chapter there is another chapter in the book. Just have to find it real quick. That deals with the ratios. Yeah. So it's really, that's one of the parts that I haven't mastered yet. So don't nail me on anything there. And by the way, just in case I haven't mentioned it yet, obviously this stream is purely for educational purposes. Everything that I share in this stream/video is my personal opinion and in no way financial or professional advice of any kind. You should always do your own research, consult certified professionals, draw your own conclusions, and most importantly, make your own decisions. Yeah. So that said, we are looking for the part that is about the ratios. Ratios do we have here? Nope. Nope. Okay, there we would have an example, multiple wave relationships. Keep in mind that all degrees of trend are always operating in the market at the same time. Therefore, at any given moment, the market will be full of Fibonacci ratio relationships, all occurring with respect to the various wave degrees unfolding. It follows that future levels that will create several Fibonacci relationships have a greater likelihood of marking a turn than a level that will create only one. For instance, if a 0.618 retracement of a primary wave 1 by primary wave 2 gives a particular target, and within it as a 1.618 multiple of intermediate wave A in an irregular correction gives the same target to intermediate wave C, and within that a 1.0 multiple of minor wave 1 gives the same target, yet again for minor wave 5, then you have a powerful argument for expecting a turn at that calculated price level. So that's a lot of words. But thankfully, there's an example, which means if this wave 1 here has a price, so the wave 1 0.618 retracement points till here, and then we assume a corrective pattern A, B, C, and we already have some A, B developed and a little bit of the wave C as well, and that A, B, blah, blah, blah. So the 1.618 retracement, or not retracement in that case, but extension, would target the same point. And then when we work out the impulse wave, that is the wave C here, the forecast for wave 5 also points to that. Then we would know, okay, this is a very likely end of our wave 2 where the price will turn around. Yeah. Probably should steal more Kitty bookmarks to also have that. But we're around page 145. So, and here we were around page 87. Yeah. So we're just going to say roughly times, not 2, but yeah. No, actually roughly time. Yeah, not roughly times 2. Anyway, that brings us back to the charts. Screen share, and that brings us back to, first of all, for now, getting rid of what we have in place here. Yes, get rid of the child waves. So, and zooming out again, a monthly chart, and then getting ourselves a Fibonacci retracement that we throw on the chart from here to here. Because although the example right now mentioned the 6.18 retracement, which would be down here, there is also a popular case. I'm gonna actually check if we find it in the book real quick, so we have something to back up my words and not just trust me, bro. Again, Descam, so we were at 145. So multiple wave relationships, ratio analysis, yep. So do we have an example? Those are extensions, motive wave, figure 2. There we don't have that. There we have. So we have here on page 135 in chapter 4 of the ratio analysis, retracement. So the first one would be a zigzag correction based on my gut feeling or whatever experience, however you want to call it. The second one would be a flat correction, with you see, as we mentioned earlier, wave B going higher. And here we see for the zigzag, the ratio used in the example is basically a 0.618 retracement, whereas for the flat, it's only a 0.382. Now I'm gonna quickly read the text. Occasionally a correction retraces a Fibonacci percentage of the preceding wave. As illustrated in figure 4.1, which is this one, sharp corrections tend more often to retrace 61.8 or 50% of the previous wave, particularly when they occur as wave 2 of an impulse, wave B of a larger zigzag, or wave X in a multiple zigzag. A leading diagonal in the wave 1 position is typically followed by a zigzag retracement of 78 point blah blah blah. Sideways corrections tend more often to retrace 38.2% of the previous impulse wave, particularly when they occur as wave 4 as shown in figure 4.2. Retracements come in all sizes. The ratios shown are merely tendencies. Unfortunately, that is where most analysts place an inordinate focus, because measuring retracements is easy, far more precise and reliable. However, are relationships between alternate waves or lengths unfolding in the same direction, as explained in the next section, which means we cannot just say it will be 38.2 or 50 or 618. However, I'm not sure if we have that one. Actually, we'll look for that one. Do we have that one on impulse waves? Yeah, I will look for that one later. So there is also not a rule, but probably a guideline more, screen share, that basically wave 2 of an impulse retraces into the area or to the point of wave 4 of the previous impulse of a lower degree. So that would be that one. The previous impulse of a lower degree is what makes up our wave 1. And now if we look at two things, first of all, that it might be a flat corrective pattern here that we're looking at, although zigzags are very likely as well, yeah. Second of all, that in a sideways flat corrective pattern, the tendency, so not guaranteed, but the tendency would be a retracement to the 38.2 percentage line, whatever, yeah. And that wave 2 tends to fall into or retrace into the area of the previous wave 4, or to the point wave 4. I have to look it up again, so to say it word for word, but for now let's go with into the area, which means we would have at least so the tendency that the retracement would go here, the wave 4 rule that it should go here, or previous impulse of a lower degree guideline that it should go here, which would least gives us at least two arguments that we are actually trying to label out something that looks like that looks like this, so that ends down here. However, if we are looking at a flat corrective pattern, so that would be sideways, then we would also expect a new all-time high as part of this. Yeah, so that would be, or at least we say at the same all-time high, because again, wave B would be 100 to 138% of wave A. Yeah, which brings us in a pickle, because it basically, as I said, it like what we did earlier the last 2 days obviously still was valid as far as it followed the rules, but as mentioned, we were missing out waves of some degrees. So we were basically looking at this here, or not even this here, but this, no, we were looking at this here and completely ignoring this here and this here. So 2 wave degrees at least in between, which, by the way, if we circle back to wave bases here, then we can see that their automated projection, which might not always be accurate and so on, because it doesn't consider all the different nuanced wave patterns that there are, also would point us into the area of, basically, if we narrow it down, of like 1,900 to 2,262. Whereas if we circle back, our projection here would be the 2,263. So we would basically project that we will end up here right now. Yeah. And anyway, so right now the assumption would be that we are going there, and that would then make up our wave 2. However, an important thing that we are missing here, so that would be wave 2 of this degree, yeah, based on our starting point in 2009, which doesn't look, I mean, which already looks bad, because we would consider another almost 45% drop in the SPX, but it actually gets worse in quotes, because if we look at the SPX from the beginning, that subwave here is not confirmed in any way. It was just done during episode 1 of the daily market mastery, but it would actually mean there should also be Fibonacci retracements here somewhere. Yeah, if we throw a Fibonacci retracement on here, yeah, that doesn't look right in terms of percentages. So that's definitely not right. But yeah, if we go with the rule of like we retrace in the area of wave 4 of the previous impulse as an example, so we would actually expect that over the next couple of years, obviously it doesn't happen overnight, that we retrace into the area down here, which actually is another, 80% drop or so. And which also means that we actually have to look out for a pattern that is like A, B, C, and try to find this one. For that, however, to do that properly, I first will have to find the time to reconfigure my data sources, because right now I'm only using my interactive broker portfolio as data source. And as we see, we only get history from 2003 or 2004. So we're missing a lot of historical data that we could use to work with, which kind of like, yeah, like not harms us, but prevents us from like seeing the bigger picture in motive wave. And we have to keep in mind when we're labeling things to also double check with other sources to know what we're actually looking at. Yeah. Now, unfortunately, we didn't make a lot of progress today. However, the 30 minutes that I scheduled for the stream are already up. We're gonna continue this probably on Monday. So if you haven't, smash the subscribe button and enable notifications. Tomorrow there will not be a stream because I have other things planned already. But on Monday there should be one. I will schedule it on the weekend, or at least as soon as I know that my Monday is free. And yeah, and then we'll basically continue here trying to work out, based on Elliott Wave Theory, where exactly the SPX 500 is going to go next. And once we manage to figure that out, so to find a labeling that actually follows all the rules and guidelines of Elliott Wave Theory, we will move on probably to the NASDAQ as the next target. Now, yeah, so that's pretty much it for today. Don't forget, you can always check the description down below to basically read the Elliott Wave Principle book for free online, and download your free one-page cheat sheet that contains all the wave patterns that there are, with really, really helpful, like guidelines, rules, and information. And yeah, so that's it. Thank you all for tuning in, and see you all next week with another episode.